Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael Siding. Today, I'm doing a deep dive into Evolution, or Evolution Gaming, the Swedish company Evolution. We'll start with the screening, and this time I'm going to make it really simple. And I think this is a pretty powerful screening procedure, actually. And it's simply screen among really good and earlier beloved companies, angels, darlings, whatever you like to call them, and if they have fallen by a lot recently or over a couple of years, then that might be the turning point. You of course can't know that, but we'll get to that a little bit later. And right now, for example, we are in the quarterly earnings season, and just 2 days ago, Evolution presented their Q1 earnings, and it was a bit disappointing. Not that disappointing, actually, but the share price fell by 20%. So 20% lower means a 25% upside just to get back to where it was. So that could be a buying opportunity, but let's not get ahead of ourselves. This is how I started it. There was an earnings crash on April 30, and the numbers that we see for Evolution are, for example, a PE ratio of 10.4. Again, since this is very early after the crash, hours really, we can't rely on these numbers and these estimates. We have to make our own, but this could at least be a starting point because it is the official multiples and earnings forecasts that the market is using and that we used at least before this earnings report. And it's these numbers that together come together to become the market average. And as you might recall, the market historical PE average is about 16.5 times backward looking, and this 10.4 estimate is also backward looking. So there's a 60 to 65% upside just to be valued as the market. So what we want to know is how unreliable is the current EPS level? Will it fall permanently by a lot for the rest of the future? Or might it actually, after a short-term hiccup, get back on track just as before? And this is just a scare. And after that, we have a company that might grow like the rest of the market, or a little bit slower, or actually a little bit faster. So the question is, has this stellar company, this company that has grown so fast with so high margins and a nice dividend, has it really permanently become a worse company? So much worse that the price drop from 1,700 kronor to 675, that is actually warranted? We'll see. Let's start with the technical analysis. I often say that you should check the 3-year performance. If the 3-year performance has been strong, but recent times has been weak, then that could be an indication of a strong and well-managed company that the market participants are learning to understand and like in terms of price performance and risk reward. But you could also just look at it the complete other way. If you have a 4-year really lousy performance, that might just be that the stock is temporarily out of favor, or that there are flows from the industry or from that particular company. And the reason that fundamental investing works so well over long periods of time is that companies tend to become very overvalued and very undervalued due to the flowing and the trends and fads of investors. So what is the difference between, let's look at this chart here for evolution. What's the difference between buying at a downturn like this, or like this, or like this? What's the difference now compared to the earlier negative share price performance times? Well, the difference is valuation. Back here, the valuation simply was unsustainable. The market was expecting super high growth to continue more or less indefinitely, or at least for a couple of more years. And there was no critique or inhibitions at all when it came to investors wanting to jump on this bandwagon. However, we should point out that there is a clear negative trend here with falling highs. That should have been apparent here, where I'm moving the cursor. That should have been a signal that this stock had pretty much negativity to come, especially here when it turned below its 200-day moving average. Because once below the 200 moving average and still pretty expensive, and this downward trend and crashing through earlier important levels, that would have been, this would have definitely have been a time to really question one's holding in evolution. Now, sure, we are below the 200 daily moving average, and that is also a negative signal. We can also see here at when the earnings report arrived, we got this sharp break and also below previous recent lows. So apparently weak hands are leaving this stock and creating pressure on it. So is this a permanently fallen darling, or is there actually light in the end of the tunnel? Well, if we look at the number of shareholders in Avanza, so this does not take into account all shareholders, but it's a good indication. We can see that some have left the company over the last 3-4 years, but there has not been an exodus. So there is actually thus plenty of room on the downside on a future stampede out of the stock, and so that's a little bit worrying. We also have technical analysis on the market being negative. Remember, above the 200-day average is positive, but as soon as you go below and fail to recapture it, so this is a failed attempt, and then we're going down again, and maybe right now we're trying once more to get back up to the 200-day moving average. But this is a clear macro picture headwind. We also remember from all previous videos that the market multiple is expensive. So that too is, in general, a headwind. However, high valuation multiples, absolutely for the market, means that single stocks can also be a little bit more attracted to that high level, even if it's weakening. But in general, having high market valuation multiples that are starting to roll over, that creates a negative sentiment, and that's also probably why we are seeing the 200-day moving average for the stock price, so not the valuation, so for the stock price, rolling over and staying below the 200 days. So that's a headwind. This is probably a headwind, or could be, in terms of the number of shareholders. This capitulation break here might be what's causing, or will cause, a stampede out of the stock. So from a TA perspective, there is a lot to be concerned about. So that should be a call to caution.